day, and welcome to the Anand Rathi Share and Stock Brokers Limited Q4 FY27 earnings conference call hosted by EY. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Cyril Paul from EY. Thank you, and over to you, sir.
Thank you, Swapnali. Good evening, everyone, and welcome to the Q1 FY27 earnings call of Anand Rathi Share and Stock Brokers Limited. The company has published its results and has uploaded their investor presentation on the exchanges yesterday, and you can also find them on the company's website. Before we start, a disclaimer. Some of the statements made in today's earnings call may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which can cause actual results to differ from those anticipated. Such statements are made on management beliefs and assumptions made by information currently available to the management. Audiences are cautioned not to place undue reliance on these forward-looking statements while making their investment decisions. And on that note, let me introduce you to the management. We have with us Mr. Pradeep Gupta, Chairman and Managing Director, Mr. Roop Kishore Bhutra, Whole-Time Director, Mr. Tarak Shah, Chief Financial Officer, and other members of the team. Without further ado, I'd like to hand over the call to Mr. Gupta for his opening remarks. Thank you, and over to you, sir.
Thank you, Cyril. Good evening to all of you, and a warm welcome to our first earnings call for the new financial year. For FY27 has commenced against a backdrop of both challenges and opportunities. The Indian equity markets navigated a complex operating environment during Q1 FY27, shaped by heightened geopolitical tension, global macroeconomic uncertainties, and elevated volatility. The West Asia crisis and the sustained uncertainty around the Strait of Hormuz led to a temporary spike in crude oil prices, exerting second-order pressure on input costs across industries globally and contributing to currency volatility. Foreign outflow continues through the quarter, totaling roughly 1.43 lakh crore across April-June quarter, compared with the 1.31 lakh crore during Jan-March 26 quarter. India's monsoon began with a sharp 40% rainfall deficit in June due to El Nino, though early July has seen a recovery that has narrowed the shortfall to around 20% below normal, supporting a catch-up in Kharif sowing activity. While these developments weigh on risk sentiment and kept investors cautious, the Indian economy and capital markets have continued to demonstrate remarkable resilience, supported by strong domestic liquidity, healthy macroeconomic fundamentals, and sustained participation from domestic investors. This confidence was reflected in the market performance, with benchmark indices gaining roughly about 6 to 7% sequentially. Retail investors continue to participate in the capital market story, as demonstrated by India's demat account base increased to 23 crore in June. Also, the mutual fund industry, yet another barometer of investor sentiment, continued its strong growth trajectory, with industry AUM reaching to 82.2 lakh crore in June 26 from 73.73 lakh crore in March 26, highlighting continued investor preference for market-linked saving avenues. This is also sustained with new SIP additions during the June month, touching to about 66 lakh compared to 53 lakh during month of March. It is encouraging to note that this positive sentiment was not limited to investors alone. Corporate India also continued to demonstrate confidence in the capital market, as reflected in a strong pipeline of about 42 companies filing draft offer documents with SEBI during the quarter, reaffirming the continued attractiveness of Indian capital market as a platform for growth and capital formation. It is pertinent to note that the broking industry is transitioning into a phase of more measured activity following the exceptional growth witnessed over the last few years. While the investor base continued to expand, accompanied with growth in cash market turnover sequentially by roughly about 13%. Moderation is seen in the trading activity in the derivative segment, indicating the incremental participation is increasingly being driven by long-term investing rather than purely trading-led activities. A key driver of this transition has been the evolving regulatory framework. Both SEBI and the RBI have been taking a series of calibrated measures aimed at strengthening market resilience, improving risk discipline, reducing excessive leverage, and enhancing investor protection within the financial system. SEBI's measures in the equity derivative segment, including upfront collection of option premium, tighter expiry day margin treatment, enhanced intraday position monitoring, higher contract sizes, and rationalizing of weekly expiries are aimed at curbing excessive speculative activities and improving investor protection. In parallel, the RBI's revised capital market exposure framework, now effective from July 1st, 26, introduced a more principle-based approach to bank lending to capital market intermediaries, resulting in increase in the working capital significantly. Now, speaking about our company, I'm happy to report that our business model remains well aligned to the evolving regulatory environment, with our focus strategy centered around maintaining a diversified revenue mix and a strong focus on client-led businesses. We believe we are well poised to navigate these changes while continuing to create long-term value for our stakeholders. The effectiveness of this strategy is clearly reflecting in our financial metrics. During the quarter, our total revenue from operations for the quarter stood at about 2,461 million, representing a growth of 22.37% YOY. EBITDA grew by 30.19% to 973 million, translating into a healthy EBITDA margin of 39.54%, and PAT before exceptional items grew by almost 71.2% to 391 million, translating to PAT margin before exceptional items of 16%. Our asset under custody stood at about 1.13 lakh crore, representing an annual growth of about 21.44% from Q1 26. Our MTF book stood at 13,318 million, with a strong rise of about 55% from last year, while the distribution AUM, which gives us a long trail income, reached to 94,791 million, growing by about 25.82% YOY. Encouragingly, the expanding asset base has been complemented by healthy levels of client activity. During this quarter, we have recognized an exceptional expense of about 209.96 million towards the restoration of securities of two of our clients in depository segment businesses who suffered losses due to fraudulent off-market transfer from their demat account. The aforesaid amount includes the contingent liability disclosed in previous quarter, which has now been recognized as expense along with the impact of fraud identified during the current quarter in continuation to previous fraud. We have reported the incident to relevant authorities, including the depositories and stock exchanges, and has also lodged an FIR with Economic Offence Wing. The matter is currently under investigation with the relevant authorities. Nevertheless, as a matter of prudence, and pending outcome of investigation, we have recognized the related outflow as of exceptional expense in the current quarter. We further state that the EOW has traced the money trail and has attached certain assets and bank accounts of the beneficiaries of fraudulent transactions. Further, we have filed insurance claim to recover the eligible losses incurred. We update for as and when action becomes reasonably certain. To further strengthen our internal control and processes, we have also hired an external consultant to have their valuable input and to incorporate the same wherever required to ensure such incidents do not occur in future. Going ahead, we expect our MTF book to reach around 1,750 to 1,800 crore by end of this financial year, while distribution AUM is targeted to scale by 40%, driven by higher wallet share of existing clients and disciplined risk management. As guided earlier, we will continue to move towards maintaining a 50-50 mix between our broking and non-broking income, despite active growth in both the businesses. Another key priority is to deepen our client engagement through enhancing our digital platform, which now offer real-time data, advanced analytics, and simplified portfolio tracking. We will focus on AI-led insights to enable a full end-to-end digital onboarding and transaction ecosystem, supported by deep integration with India's digital public infrastructure such as UPI, account aggregator, and aggregator frameworks, and eSign and DigiLockers. We believe these initiatives will further strengthen our client franchise, improve scalability, and position us well to capture the next phase of growth. Before I conclude, I would like to take this opportunity to thank all our stakeholders, shareholders of their participation in the first annual general meeting, post-listing, and for their continued trust, encouragement, and support. With that, I would like now to hand over the call through the finances in detail.
Thank you, Pradeep. Good evening, everyone. I will give you a quick snapshot on the financial performance of first quarter financial year 27. As mentioned by Pradeep, our total revenue for the quarter stood at 2,461 million, reflecting a growth of 22% on a year-on-year basis, driven by growth in both broking and non-broking segments. On the profitability front, EBITDA for the quarter stood at 973 million, translating into an EBITDA margin of 39.54%, while PAT before exceptional item came in at 391 million, growing by 71.22% year-on-year basis, with a PAT margin before exceptional item of 16%, and PAT after exceptional item is 233.51 million, growing by 2.35% YOY basis, with a PAT margin after exceptional item of 9.49%. At segmental level, our revenue mix during the quarter remained well balanced, with 52% contributed by the broking business, 29% by the non-broking segment, comprising of MTF plus distribution, while remaining from other income. We continue to consistently focus on maintaining a near 50-50 mix over the medium terms, thereby reducing the impact of market volatility in the broking business on overall top line and ensuring greater stability and predictability of earnings. Within this framework, our broking income stood at 1,280 million, of which 51% came from equity cash segment, which is our core focus area. In the non-broking segment, interest income from our MTF book contributed 428 million, while income from distribution stood at 275 million. Revenue from broking and related services has increased by approximately 7% on quarter-on-quarter basis, and MTF book and distribution AUM has increased by approximately 22% on quarter-on-quarter basis. During the quarter, our external credit rating was upgraded to A1 plus for short-term bank facilities and were assigned a credit rating of A plus for long-term bank facilities. Our debt equity ratio stands at 0.81 as of 30th June, which enables to increase our borrowings limit at reasonable cost. At the same time, we continue to invest in building our human capital, which remains a key differentiator for us. Our employee base has grown to 2,263 during the quarter, up from 2,148 in quarter 1 26, reflecting our continued focus on strengthening execution capabilities and supporting long-term growth. Equally, the strength of our franchise is reflected in the longevity of our client relationships. Approximately 57% of our clients have been associated for over 3 years, underscoring strong client stickiness and trust in our platform. Overall, the quarter reflects the strength and resilience of our business model. While the operating environment remains dynamic, we believe our diversified approach positions well to navigate near-term challenges and capture emerging opportunities. We are now open to any questions you may have.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all, you may press star and one to ask a question. We will take the first question from the line of Nachiket Kale from NK. Please go ahead.
Yeah, hi, good evening, sir. Thanks for the opportunity. And also thankful for the insightful opening remarks. It's good to know that you have also expanded your team and the employee count has gone up. So carrying on that front, just a macro question, what is your general outlook on the capital markets overall, given that the volatility we've seen and the regulator curves on F&O? And coupled with that, on the retail front, we've delivered commendable non-broking growth. So could you please comment further on what is the strategy and outlook on that?
Thank you for the question. Just to address over here, in my opinion, and we believe that future for the capital market is definitely good, and we believe there is going to be a constant growth going to happen going forward. I personally feel next 3 years are going to be good, at least in coming days. Though we are seeing intermittently, there are concerns because of geopolitical reason or otherwise. But I personally feel that the GDP growth which is happening in our country is going to take you to a different level. And probably now the valuations are at a space where probably, people will again start looking at. So whatever FI outflow we have seen, we have already, experienced in later days, in initial days of July first week. I think that have mellowed down to a greater extent, and over a period of time, I think this may become positive. So I personally feel that capital market conditions are good, and it's good for broking industry and capital market related activities also. Now, in terms of our overall strategy, we have been constantly talking that pure broking businesses are obviously susceptible to the volatility because of a simple reason: capital market, more specifically broking side, has gotten volatility on a short-term basis. To reduce that volatility from our earnings, we have, taken a route to go for a non-broking side, which consists of all the distribution of financial products as well as a margin trading funding book. And that's where we are constantly, looking at it. And as a result, we have already reached to somewhere around 9,500 crore kind of asset under management in our distribution book. And if you really look at it, our MTF book, where we have already reached to somewhere around 1,330 crore. So I think, and our focus is constantly there. We believe that there is going to be a growth consistently coming or happening on a distribution side, and we believe we are going to grow on a distribution side by about 40%. In terms of our MTF book, this is also a part of, how much capital you can infuse and how much free capital or liquid capital is available with you, or how you can probably raise the funds and probably put that capital for funding side. But this year we are aiming to reach to somewhere around 1,750 to 1,800 crore kind of MTF book from presently 1,330 crore kind of a book. So that's what the status is, and we believe that this is going to constantly grow in near future also.
Right, but sir, in the grand scheme of things, what is the risk management approach towards MTF? Because we have seen across the industry, MTF volumes are picking up majorly once the F&O curves came in. So people are looking at it, to leverage for maximum gain. But the reverse is also true. So what is the risk management approach towards that?
So you are absolutely right. This book is susceptible to risk, but it all depends how you are trying and managing your risk. So, we have done 2-3 things. One is we are not providing, this MTF book is not being allocated by anyone towards F&O side. This is largely for a cash market transactions. So there is a security of cash market. And internally what we have done, that we have segregated, and whatever about 2,000 plus kind of scripts are available for MTF book side. And we have selected and chosen certain amount of securities within our selection criteria, and we are funding and financing against only those kind of securities. And again, if you really see our book position, our large portion of book position is below 1 crore. That says that we are not taking a concentrated effort on a specific customer base. Similarly, we are also not, we have created a various different parameters. That is where our concentration on one specific scripts is not happening, and we are also not giving funding or financing or MTF loan to the customer beyond an individual specific limit being set by us. So these are few of our internal control which we have put in, and as a result, you will be happy to note that we have been working in this space since 2017, and there is not a single paisa or pi is being lost, or we have seen any kind of a delinquencies in our this MTF book. So yes, it all depends on management, and we are doing, and our risk management is quite capable to control all the risks which may or which can happen in this particular book.
Okay, great. Thanks, sir. That's all from my side.
Thank you. We will take the next question from the line of Yash Churani from Code Advisors. Please go ahead.
Hello, am I audible?
Yes,
Yeah,
you're audible.
you are audible,
Yeah.
Mr. Yash.
So I just had two small questions. One was on the MTF loan book, which grew around 21% this quarter, but interest earned on it stayed kind of flat. And like I just wanted to know why is that? And is the MTF rate coming down overall in the industry, or did the loan growth say generally happened in the last quarter? So that was the first question. And the second one being, most of our clients are older and loyal, say at around 57% or 3+ years. But as young investors say come into the market and the average turnover increases overall, they go straight towards the app. Where do you see the next clients at your end coming from? I think that's the two.
Yeah.
Yes. So it's a really good question where you have rightly analyzed that yes, our MTF interest income that is flat in Q4 and the current Q1. So there is one important thing which is there in both the quarter. If you go in terms of the average book which is there, that book is flat. But the positive aspect which is there, that in March month actually the book got reduced because you might be aware about that particular month, the market fell down by 15% approximately in terms of mid cap side. So book size has reduced and book size went down in last quarter, and it was there to the extent of 1100 crore. But post that the book has started increasing on gradual basis, and book has reached by the year end at a peak level of 1330 crore. So that since the average book size in both the quarter was at par, so that's why the interest income was at a flat level. But the positive thing, that book is now continuously growing in this particular quarter. So this is the reason that interest income is on flat side. And second thing you have asked in terms of
So you have asked about the 57% 3-year plus, and looking at the young population who are largely attracting towards the app side. If you really see our model, we are largely targeting those customers who are well understood and in age group of about 25 to 30 years, because of the simple reason those are the customers who are literally right enough and understand enough about the investment philosophy, and they are largely working and looking at wealth creation and wealth building by way of investing in investment products such as equity and other investment products such as mutual fund, AIF and PMS and so on and so forth. And that's where our target customer lies. Having said that, all those customers at the initial edge bracket, those who are interested in investment and those who wants to only look at investment are also our target customer through our app, and they are literally coming on the app through us also, with us also. But if you really look at and glance through the market side, largely those young customers are opting the F&O over investment in cash market, and that's where initially 3 to 5 years they work on a trading activities, they execute their trades on F&O basis in F&O businesses, and once they understand that they cannot devote time, they cannot keep pace with those kind of a trading activity, as well as they lost their money over there, then they start changing their strategies and come to investment platform and look at investment as an avenue. So in our case, obviously, we are deliberately looking at those kind of customers who are looking for an investment solution and interested to invest and create their growth. And that's the reason you will find about 30 years plus customer base is with us in large, and the longevity of customer base with us for more than 3 year, 5 year is 49%.
So just one small follow-up, just need a number if it's possible. Could we know the customer acquisition cost that we take to get these kinds of customers above the age of 30? Is it possible for us to know?
So typically, if you really see, we do not really maintain and manage from a customer acquisition cost, because of the simple reason we do have RMs who are supporting and assisting our customers all across the country. Now these RMs are getting lots of referrals because of our services standards, because of our deliveries, and we are also acquiring these customers by way of doing various different activities in various different places and regions. So based on those activities, we invite customers to and educate them on various different platforms on investment and investment products, and that's where the existing customer as well as prospective customer comes, hear our views on a different platform, and then they start chasing us and talking to us for their investments. And that's the reason we really can't make out what is the actual cost to acquire a specific customer base. But by and large, with these activities, our our customer acquisition cost is really in control.
Okay. Just to add to it, apart from our own, I can say the B2C channel, we have B2B channel which is equally strong, and there all our business partner or franchisee, they are there on the complete variable model. So they are also acquiring client on constant basis based on their relationship, and actually in that particular vertical, the cost is again the zero in terms of any acquisition.
Understood. Thank you so much.
Thank you. Before we take the next question, a reminder to all the participants, you may press star and one to ask a question. We have the next question from the line of Arka Bhattacharya from Finance Analytics. Please go ahead.
Yeah, hi, good afternoon, sir. Congratulations on the good set of numbers. I have one question regarding this 21 crore compensation that has been made to the clients. Any specific enhancements that you have made to this digital security framework so that these things do not happen in future?
I'm sorry, Mr. Bhattacharya, can you just repeat the question? I can't really get your voice clearly. Can you just repeat again?
Yes, sir. Sorry for this. I was asking that there was this 21 CR of compensation that our company has made to the clients. So I just wanted to know, is there a specific measurements that has been taken to handle this kind of security framework, which might not repeat in future, so that like these things will not impact the balance sheet?
Yeah. So, Mr. Bhattacharya, you might have heard, and I have covered in my address, that this is a typical fraudulent activity which has occurred in our depository side. In our company, we are depository participant also, and this activity had happened with two of our customers who were dormant in nature. That means their DP holdings are there with us since long, but there was no major activity happening in DP buying and DP transfer, as well as they were not active at all with us in our trading platform. So what had happened, some fraudster has taken a clue and started embezzle and transfer these securities in their account. And this was not being realized by the investor till almost in a year's time. It was after pointing out, after internal assessment, we found, and when we spoke to the investor and we talked to them, then we came to know that some activity had happened with these two customers. We went into a detail, checked all our processes. We found all the maximum processes are being followed, and there are certain amount of activity for which we appointed, outside agency, including EY, to do forensic audit as well as to run through a complete check of our processes and system. That thing is still happening, and whatever report or overall suggestions going to come, we are destined to implement that to strengthen our processes. At the same time, internally, we have looked at our processes, and wherever fine-tuning in the process is to be done, we have already done that. In terms of, reporting this case to various authorities, we have done that, including police with EOW. The investigation is still on, and money trail, whatever money trail so far, police has been able to recover and seen. They have frozen those assets in those accounts. As you know, this is a process where probably they have to complete the investigation, and then only will come to know how much amount can be recovered over there. At the same time, we have also lodged our complaint with the insurance companies and giving them all the data and record and supporting, so that they can take and evaluate the whole matter and then settle the claim. So we are expecting that the claim settlement, and by way of recovering from the freeze assets which are being frozen by the police authority, we will be able to recover sizable amount out of the money which is being spent by the company and shown over here as a one-time expense. I personally feel that it's a matter of time, and since we have to replenish these securities as a great goodwill gesture, as well as to our customer, we have provided all the securities which is being lost by those customers into their account. And while procuring those securities from the market, whatever cost which we have to incur has been debited to the P&L. There was no other way we can probably show and reflect into our P&L, and that's the way we have shown it and disclosed all the facts about this case into our Q1 27 financials.
Thank you, sir. Thanks a lot for the detailed answer. And regarding the subsidiary part that you are making, the expansion, this move that state has been taken, just wanted to understand, given your wealth manager DNA, what is the target asset, target AUM that you are planning to do in this next 12 to 18 months in Dubai?
So typically this, as you know, we are also addressing and servicing lots of NRI customer base from India. And our, RM teams are supporting and assisting and guiding, and those NRI also are active on our online app. We found that lots of NRI from UAE regions are constantly working with us and seeing and requesting us to give them a little bit more active support to address the need, and we see the potential is there in that UAE region. To looking at that, we have to create a structure where probably we can assist, guide and market and show them the investment product into that region to those NRI who are willing to invest in India. To do that, we have to follow certain compliance, and for that we have to create a subsidiary. And that's the reason we have passed a resolution to create a subsidiary unit in Dubai and get necessary licenses, so that we can address the need of those customers without any regulatory hurdles.
Excellent, sir. The last question that I have on the future revenue guidance. In the last Concall, our chairman has guided for the long-term overall revenue growth should be between 15 to 20% year-on-year. So in the quarter FY27, the revenue from this operation already grew by 22%, I think, which is at the upper end of the long-term guidance. So this early achievement of your 50-50 diversification goal that you have, do you see any headroom to revise this annual growth guidance for the full year of FY27?
So our typical endeavor is going to be that we are going to constantly going to grow between 20% to 25%. 15 to 25% is a range which we have set for ourselves, and obviously we will keep on doing it and addressing this issue. As you know, till the time our dependence on broking in a larger way, till the time we are not going to achieve the 50-50% kind of a model in broking and non-broking, we will constantly see that our revenue growth should be minimum around 15 to 20%, and our bottom line, which is PAT, should grow by somewhere around 30 to 35%. And we stick to our that guidelines, and we will keep on improvising over there. Yes, we have been able to achieve 22% kind of a growth in revenue term as of now from our, year-on-year basis target, and we will keep on working towards it over a period of time.
Thank you, sir. Thank you. Thank you for everything. It answers all of my questions.
Yeah. Thank you.
Thank you. We will take the next question from the line of Priyam from Trinetra Asset Managers. Please go ahead.
Hi, thank you for the opportunity. So I just wanted to understand a lot of full service brokers have announced their decision to set up a structure in GIFT City and or set up international investing. I think that is going to be a decent lever of growth in the coming years. I just wanted to understand your thought process on it and whether we are going to do something about it.
So typically, you are absolutely right. Many of full service brokerage houses and even I would say online broking houses are trying and venturing the international offering and providing those international offering to the domestic customer base. If you really look at it, we do have our one subsidiary unit which is listed in GIFT City and already active and participating for these kind of an activity. And right now we are completely focusing to address the need of NRI customer base for their investment within the country. But over a period of time, we do have capacity to expand that base for international businesses. Right now, I do not see that there is much of a value addition which can be provided, because our philosophy is pretty clear that any product or any investment product which we are submitting to a customer, until unless we do not understand that product really well, and until unless we do not see a value addition being provided to our customer, we normally do not go and take a hasty decision to incorporate that product basket with us. And another little bit problem for domestic customers is that all these investments are subject to your LRA limitation, where probably you have to take permission, and under that LRS scheme, you can probably go and invest only to a certain amount of dollar, which is $250,000 per account per year. So those are the kind of limitations again can crop up. And to address those issues, one has to be very, very vigilant. And we will probably, once we will get some answer, we can look at it. But right now, we are not really providing any kind of such platform or such activity at our end. Though we are also, our distribution product team have started evaluating few of our distribution product, which is mutual fund or other products which are dollar denominated. We are researching them, we are studying them, and once we get certain amount of clarity, we believe that we have created certain amount of view on that. Those kind of a product to our NRI customer base can be a possibility which can be given to them, which can be shown to them, and we will probably provide to them.
Sure. Thank you.
Thank you. We will take the next question from the line of Shweta Sharma from Arihant Capital. Please go ahead.
Hello, am I audible?
Yes, ma'am.
Yeah, you are quite audible, Shweta. Thank you.
Thank you so much, sir, for the opportunity. So we see a QQ dip in non-broking segment this quarter. So can you throw some light on it, and how do you plan to avoid such degrowth in coming quarters?
Shweta, if you really see Q on Q basis distribution, if you compare in broking industry, and when you are looking at distribution, JFM period is largely also driven by insurance businesses. Most of the insurance businesses happen in January, February, March. And because of that, while marketing and selling these insurance policies, you have got a big amount of revenue coming from insurance businesses also. And that's the reason you will find your JFM quarter is going to be always higher. And April, May, June, the selling of those insurance policies comes down, and that makes an impact in Q-on-Q basis. Otherwise, if you really look at our AUM in mutual fund has grown, in AUM in any other product has grown on Q-on-Q basis. So revenue from those products, apart from insurance revenues, are literally growing on a steady basis. That's what is making an impact on distribution business.
Just to add to it, whatever Fred mentioned, rightly in terms of distribution side, AUM has grown, and that AUM has grown not only just because of the market changes or market-related impact. We were able to collect, in fact, in last quarter, the highest net collection basis in terms of AUM. So we were able to add that particular part. And in terms of, I can say, the revenue side, since, as I mentioned earlier, that in March month, market was down almost by 14 to 15%, for which the impact was continued in terms of this particular, I can say, last quarter at the initial period in terms of trail revenue also, because whenever, as you know, well, that in case of when market is falling in this kind of scenario, immediately it is getting, I can say, the trail revenue is reducing. But the overall basis, we were able to increase all those businesses other than the insurance business.
Okay, thank you so much, sir. My second question is, the debt equity ratio appears elevated this quarter. So, could you explain the reason behind such increase, and going forward, should we expect any further increase in leverage?
Our idea is surely there to increase the debt equity ratio. In fact, debt equity ratio earlier it came down because naturally with the infusion of the money through IPO, immediately the capital infusion took place, but the borrowings will take later on the place. Our idea is surely to improve this debt equity ratio. We are very much comfortable. And in the industry on overall basis, people are there at around 1.5 to 2 kind of debt equity ratio, which is a very comfortable scenario. Currently, we are there just at 0.8 times, and we are constantly going for the borrowing to improve our both on the MTF book side as well as the overall total, I can say, the book side. So we will continuously work towards that in terms of borrowing. And for that particular thing, as I mentioned, our rating has also improved, which is going to help us in terms of having that particular borrowing part.
Just to add what Mr. Roop says, Shweta, in our businesses, we are borrowing money only to expand our businesses, to take care of our working capital requirement as well as put that money for margin trading facility. So whatever borrowing is happening, whatever debt equity is happening, in fact, that is yielding results by way of, interest income in MTF as well as broking income. And that's where, you are trying to multiply and you are trying to gain over there. So that's how this whole borrowing is going to be utilized. So it's just a positive thing in the sense that we are not crossing the boundaries and we are not over leveraging that. I believe in this scenario, in this industry, 2-time kind of a debt equity is reasonable. And we were there when we raised the fund, we were there somewhere around 1.2, around 2 time of a debt equity. And at that point of time, we have infused the capital.
Okay, thank you so much, sir. That's all from my side. Thank you.
Thank you. We will take the next question from the line of Deep Himani from Choice Equities. Please go ahead.
Sure. Thank you so much for the opportunity. So I have one question. Sir, can you please share the blended yield that is being currently earned on the MTF book, and what would be the average cost of funds during the quarter?
Our yield in terms of MTF book is around 14% kind of level. And naturally, on that particular additional income in terms of brokerage is generated towards the cash market delivery side, that is separate.
Okay. And so on the last question, how should investors think about? Hello, am I audible?
Yeah, you are audible. Please go ahead.
How should investors think? What would be the sustainability of spreads going forward?
So this is a impact of market conditions, how much liquid the market is. For example, borrowing happening in the market right now because of liquidity concerns, tightness of liquidity, the borrowing is going to be at a little higher rate. But at the same time, the same impact can be passed on to the investor, because if anybody would like to raise funds in MTF book, you can raise that. So this is a completely individualistic approach, I personally feel, and there are enough, margins available, and you can probably play this book really well if you have that kind of skills available with you, and the kind of customer base to whom you are literally addressing.
Okay, sir. Thank you. That's it from my side.
Thank you, Mr. Dhawan.
Thank you very much. Ladies and gentlemen, that will be the last question for today. I now hand the conference over to Mr. Pradeep Gupta for the closing comments. Thank you, and over to you, sir.
So thank you, investors. Thanks a lot for all your guidance, support, and the kind of a question you are asking. We at Anand Rathi Share and Stock Broking Limited are always committed for the well-being and goodness and constant growth of all our stakeholders, and we remain committed for that. Thank you. Thanks a lot, and a good day.
Thank you, members of the management. On behalf of EY, we conclude this conference. Thank you everyone for joining with us today, and you may now disconnect your lines. Thank you.